Wondering what DeFi is? DeFi is a term used to describe the phenomenon of decentralized finance. In the past, we've always relied on centralized finance, which means that there's a single source of funding, a body that oversees the movement of money. It is regulated by the government and the banks. They don't say they are, but they are able to print additional money. They have the power to prevent you from borrowing it if they so desire. They can even prevent you from opening a bank account if they want to. They may even seize your money at any time if they choose to. It's all because they're the one who authorizes you to keep your money. You pay them with your money. It was built on trust. Additionally, if you're a business owner, you may be limited in what you can undertake. For example, if you own a casino that specializes in gambling and betting, the bank can warn you not to deposit any money from the casino into the bank account. It means you won't be able to put it in a bank, invest it, or even use it for protection. Furthermore, standard financing is rather costly. Up to 500% can be used on payday loans. The average cost of a card is 25%, and even a personal loan can charge you 18%. They are absolutely large fees, but you must pay them because that is what you have been charged. Decentralized finance, in which there are no banks, is an alternative. Instead, there are a few bits of code that are able to run and manage like a bank. Every person is welcome. Because they're just bits of codes operating a program, you don't have to believe them. You can even look through it and make sure it's not a ripoff, if you wanted to. They are also able to evade censorship. Finally, they are far less expensive than the traditional centralized finance. Cryptography, blockchain technology, and smart contracts are the three fundamental components of decentralized finance. We strongly recommend that you watch our other videos on these subjects if you don't know what they are. They can simply explain them to you in a way that even a grandma would be able to follow. Welcome to Cryptique, a channel that gives critical evaluation or analysis, especially in dealing with crypto. Everything regarding money, finance, investing, cryptocurrency, and blockchain-related topics including ICOs, NFTs, and yield farming. Now, back to the video.
Okay.
Presuming you're familiar with cryptography, the blockchain, and how smart contracts function, let's take a look at the 5 pillars of decentralized banking. First, coins that are stable. So, first and foremost, we must comprehend the link between decentralized and centralized finance, which is cryptocurrency that is connected to a real-world asset. Stable coins such as DAI, Tether, and the USD coin are examples of this. This is due to the fact that their price is correlated to the dollar in the United States. Consider this. When you buy one for $1, a new one is coined every time you withdraw one. When a $1 coin is burned, it is always valued for $1 in the United States. The goal now is to provide a dependable means to buy and sell particular currencies without having to go through the hassle of doing it yourself. Instead, we can simply exchange them. Here's a good illustration of how this could be useful. Let's imagine you bought one Ethereum of $1,000 and now it's worth $2,900. And you want to sell it because you want to make a profit. If you don't convert it to stable coins, you must sell your Ethereum to a controlled exchange, such as Coinbase or Binance, for which you will be compensated in US dollars. They're going to charge a part of that transaction because they want a fee for their service. In addition, you must pay tax on any gains you earn from trading or selling. You won't be able to get around it because Coinbase and Gemini will be disclosing information that you owe them. The following step would be to wait for your bank to get them from Coinbase or Binance. You should then withdraw them out of your bank account because you don't want your money to be controlled by the bank.
No, you don't.
Let's say that after a month, the price of Ethereum has dropped to 1,000. and you want to acquire more. This means that you reinvest your 2,900 into Coinbase and then buy Ethereum again. Well, Ethereum has risen back to 2,000. After that, you plan to sell them on your centralized exchange. You pay the fee and afterwards wait for it to arrive in your bank. You can see in this instance that there are a lot of costs, taxes, and waiting. Let's imagine we choose a stablecoin such as the USDC as an example. If you buy one Ethereum for $1,000, it will increase to a total of $2,000. You trade your one Ethereum for 2,000 USDC rather than going through all of the hassle. Let's say you kept it for a month and Ethereum dropped back to 1,000, just as it did in the prior scenario. You then exchange your 2,000 USDC for 2 Ethereum. Afterwards, it rises to 2,000. And here's the good news. You can sell your Ethereum for $4,000 in less than 5 minutes. Because you employed what we call a decentralized exchange, the fees were less than 1%. We'll go through how to use a decentralized exchange to trade later. You have the ability to nearly trade immediately as a result of it. Plus, because it's simply bits of code, the USDC was safe and you trusted it. It remains the same, unlike the government-controlled Binance, Coinbase, and Gemini. People even claim to have been hacked in the past. Anyway, we've strayed off topic. That's why a stablecoin is important. You don't have to use your government-owned bank to participate in the crypto sphere. We now take banks for granted in a bunch of places, such as the United States. However, some nations have strict restrictions on how much money you can carry about and in what currency you can buy things with. In fact, any transaction worth more than $10,000 in the United States must be investigated and approved by a bank. You can, however, shift $5 million from one address to another without anybody raising an eyebrow for only around a $5 cost using a stablecoin like USDC. You couldn't accomplish it with funds from the United States dollars. Lending and borrowing are the second crucial pillars for decentralized finance. In fact, lending and borrowing money accounts for a significant portion of the world's current financial state. As a result, it's only natural that the blockchain would be able to accomplish it superiorly. We are able to lend and borrow with banks with confidence because we normally give a down payment as collateral, so that if we don't pay back the whole amount of the loan, the government will chase after us and put us in jail or force us to pay it back. In a nutshell, failing to repay a loan has legal ramifications. This is a concern with crypto, since one of the benefits of crypto is its anonymity. You may put a down payment and walk away with the remaining money. As a result, we must come up with a solution. In reality, we can utilize smart contracts to allow people to spend their money while yet preserving control of it. Let's do this as an example. Suppose that person A wishes to gain interest on his coins while person B wishes to borrow some coins. As a result, person A visits either Compound or Aave, as these are two sites that allow people to borrow and lend cryptocurrency. A smart contract is created when person A deposits his coins into it. Smart contracts, if you don't already know what they are essentially codes that do a specific task. As a result, he receives C tokens or A tokens, which are a combination of his original coin and interest. He can simply convert his A tokens or C tokens into Compounder or Aave's smart contract anytime he wishes. His original deposit plus interest is then handed out by them. The smart contract is now designed in such a way that no human beings are required to perform the calculations or perform the transaction. It's all done in a coded manner. As a result, person A's desire to earn interest in the borrowing component by lending in the traditional way is satisfied. In order to repay his loan, person B needs to do something called over-collateralized. This means that if he wishes to borrow $100, he'll have to give up $120, resulting that if he flees and never repays his loan, the smart contract will be able to repay person A's coins plus interest. You might be wondering what the point is of taking out a loan if you currently possess the money. You're likely imagining in dollars or cash. Let's imagine you have a total of $10,000 worth of Ethereum. Each one is worth $1,000. You don't desire to sell them because you are a big advocate of the Ethereum platform. As a result, you lay them down as collateral and take out a loan worth $8,000 of Tether, a stable token that is linked to the US dollar. You move that $8,000 around. You make money and you lose money. You earn again, and now that you've increased your earnings, it's time to repay your debt. Now that you have $8,500 in your Tether, you now have the ability to repay the original loan of $8,000 in order to get your 10 Ethereum back. In this case, you were lucky enough to make $500 from the small trades you made. But it's also been a few months, and Ethereum has exploded as it has been in the recent months, and now each one is worth $2,500. As a result, you now have a total of 10 Ethereum worth $2,500 each.
Oh, wow!
And as a result, you're in charge of $25,000 on top of the $500 you've earned from your trades. To put it another way, if you trust in Ethereum and want to use its value but would not want to sell it, you may take a loan on it and hope that when you cash it out, it will be worth more. Let's give an example this time when you lost some money in trades. You might lose money, win money, and then lose some more money. You finished up with $7,500 of Tether. You'd have a couple of choices. Option A is to take out an additional $500 to cover the full $8,000 debt and receive all of your collateral back. Option B is to maintain your $7,500 but lose your 10 Ethereum, which might worth a lot more money then. This may seem like a lot of information, but there is a second form of crypto loan called a flash loan. This lasts around 10 seconds. If you could purchase Ethereum for $1,000 on Coinbase and then sell it for $1,001 on Gemini, you could theoretically profit $1 for each transaction. As a result, you can practically borrow millions of dollars with what we call a flash loan. You don't have to deposit any money down, just write a $10 million flash loan. You order it to go purchase Ethereum for $1,000 and then sell it for $1,001. After that, you repay the original loan of $10 million as well as the one small smart contract that runs in 10 seconds. You essentially made $1,000, less the fees you had to pay for borrowing the money. Because the lender understood that you would be able to repay them for a short period of time, the fees are low. Although this is a more complex method, you would never be able to execute this type of trading in traditional finance. Decentralized exchanges are the third crucial pillar. So several months back, a friend of mine from the United States traveled to the Philippines. The standard currency in the Philippines is of course pesos. In the meantime, it's dollars in the United States. As a result, he was forced to convert his dollars for pesos at a foreign exchange booth. Regretfully for him, the cost was around 15%. Thus, he quickly lost 15% of his money. This comes from the fact that foreign exchange traders do this to tourists who are unaware of other alternatives. As a result, what they do is take advantage of them. When it relates to decentralized finance, we have what is known as decentralized exchange rather than a foreign exchange trader. It's a place where you may trade your coins and tokens for different ones. Currently, the costs are usually quite low, usually under 0.5%. Anyone who wishes to exchange their crypto assets on a regular basis will appreciate this. The most prominent decentralized exchanges, or DEXs, work by allowing traders to trade money that has been pooled together by investors. Every trade fee, as I previously said, is returned to those investors. It's all written in code, so it's all the same. You can't have a government intervene and tell you that you're not allowed to purchase Bitcoin anymore. It's also impossible to adjust the fees or percentages.
Nope. Have you where? Nope. Nope.
They don't alter since they're written in code. Moreover, they are unable to raise prices to insane levels such as 15%. The world is now exposed to a whole new set of tokens and coins, thanks to decentralized exchanges. The first centralized exchange to become public, Coinbase, now only allows you to buy and sell 32 coins. It's because they are managed by the government and must follow certain rules. Before adding a coin to the most popular decentralized exchange, Uniswap, they thoroughly examine it. You can trade hundreds, if not thousands, of tokens in Uniswap. They aren't governed by anyone. There are billions of dollars tied up in these liquidity pools, and that's the decentralized aspect. As a result, traders can make money, but no one has control over the billions of dollars. They're just following someone else's code. Only investors, in reality, have the ability to withdraw funds from the pool. However, if they did so, lending rates would rise. As a result, additional investors would come forward and invest. As I already stated, the code can't be modified either. It's what we refer to as immutable. We like to emphasize that the code is the law in the crypto world. It is not controlled by the government, but by the code, which is accessible to everyone. It remains the same. Uniswap is one of the most well-known exchanges for Ethereum with a pool of billions of dollars. Some other exchange on the Binance Smart Chain network, PancakeSwap, has a liquidity of a few billion dollars as well. So, if you think this video has clarified some things for you, please click the like button, subscribe, and click that bell button to be notified of our new videos. Now, back to the video.
Oh, okay.
Insurance is the fourth pillar. It's really simple to explain insurance. You spend $100 of a month for auto insurance, for example, to cover your new Tesla. However, when utilizing the autopilot mode, you are hit by a car that prompts the autopilot to fail and you end up in a ditch. You were uninjured, but the car was destroyed. Because you paid for insurance, the insurance company compensates you what the Tesla was worth, allowing you to replace it. They utilize statistics to estimate how many of their drivers will be involved in an automobile accident in the future. They then use this information to figure out how much they'll have to spend each year and how much insurance they'll have to pay each month. This is referred to as a premium well. Meanwhile, the insurance firm is a code in a decentralized financial system. Let's have a look at an example. Assume a farmer wants to purchase crop insurance. In this way, if his crops fail, he still has money to plant them. We could establish a code that if there will be any dates this summer that are 95 degrees Fahrenheit or hotter for 5 days, compensate $120,000 to Farmer John. Nevertheless, he first needs to spend $2,000 to begin this deal. As a result, Farmer John can use a smart contract to get crop insurance. The smart contract's function is that it checks to see if the conditions for him to be paid are met. I know you may have two concerns at this time. How does the smart contract determine whether the temperature is 95 degrees? What is the source of the $120,000? We'll need something called oracles to connect the actual world to the blockchain. It acts as a bridge between the real world and the crypto realm. These are reliable sources. In our city, we can establish a temperature reading oracle. It's checked by a few people to make sure it's accurate. When you use it as a reliable data source, the smart contract can decide whether the insurance criteria were met or not. Second, the $120,000 comes from people who are buying insurance on their own. They paid for the premiums, but they may not have been reimbursed since the standards were not completed. It's the same way that an insurance firm gives interest to people who supply liquidity. the centralized finance platform incentivizes investors by giving them an interest on their deposits. With that in mind, some of the hundreds of thousands of dollars could come from investors who make money by loaning their money to others. Last but not the least, there's the fifth pillar, which is margin trading. Consequently, margin trading has become a whole new beast in the world of financial trading. What is margin trading, you ask? Let me quickly demonstrate how margin trading works in the real world. After that, I'll describe it in a decentralized setting. So you want to buy some Apple stock, which is now priced at $150. So, in essence, a margin is a loan that will mechanically sell your shares if your stock falls under your down payment. You'll require a loan of $150 to buy a stock worth $150. And the investment platform offers to grant you a loan of $150, as long as you give them a little charge of 5% per year and a down payment of $30. As a result, there are two possible outcomes. The price of the stock rises from $150 to $200. Let's say that you don't have the patience to continue holding on to that stock. As a result, you chose to sell the stock and receive a profit of $200. Because the lender already received your original $30 as a down payment, you have to repay $120 off your loan. The difference is your profit to keep, a sum of $50. In other words, you were able to make $80 out of simply $30.
Damn!
Despite the fact that the stock only increased by 33%, you have more than doubled your money. This is what margins can do for you. You use it to multiply your current money when you believe something will increase in value. Let's take a glance at a different case now. The second scenario is if the stock price falls at $100. With margin, you have to sell immediately when the value of what you bought drops to the point where you aren't able to repay your loan. As a result, the stock starts at $150. After that, it begins to plummet to $140 and $135. When it reaches $120, the investment firm requires you to sell your one Apple stock for $120. It was designed this way so that you can repay the $120 they lent you. The loan is equalized by adding the $30 you gave them as a down payment. The bank now possesses the original $150 that they have given you in the first place. You are now even as your agreement ends. You've repaid your loan, but you haven't made any money. In fact, you have lost the $30 you put down as a down payment. To even get access to margin trading in centralized finance, you normally have to be able to prove you have at least a few $1,000s. In addition, the fees are substantially greater than 5%. Margin trading under decentralized finance, on the other hand, can be much faster, more accessible to everyone with money throughout the world, and much safer. To conclude this video, we've addressed 5 major pillars of decentralized finance: stablecoins, lending and borrowing, decentralized exchanges, insurance, and margin. You should now be able to appreciate the value of decentralized finance and realize why plenty of investors are committing billions of dollars in it. Acquired a lot of knowledge from this? Check out our other relevant videos from our channel. Also, share this video to any friends or family members who might find it useful. Until next time!